Oil prices continue to rise despite what is happening with COVID, the strict policies that are coming down the pipe from the Biden administration. And Biden is coming after fossil fuels, especially oil. I mean, they shut down Keystone Pipeline. The Dakota Pipeline is shutting down again, reducing the permits that he's allowing to develop on federal lands. And he is starting to talk about reducing subsidies for the oil and gas industry. And so we're going to talk about that. We're going to talk about current oil prices. Goldman Sachs continues to stand behind his $80 prediction for oil prices. We're going to talk about the Middle East. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. I talk about the latest oil and gas news. Right now, oil prices are trading at $63.61 WTI crude. Brent crude is $67.32 a barrel. Now, if you don't know what Brent crude and WTI is, WTI stands for West Texas Intermediate. If you have an oil well in Oklahoma, Texas, inland, you're going to sell it for that price. A lot of the Gulf is sold for Brent crude. It's exported. Oil to hit $80 on largest ever demand jump. Goldman Sachs expects global oil demand to realize the biggest jump ever over the next 6 months, the investment bank said on Wednesday, keeping its bullish forecast for oil prices this summer. Higher demand for travel and acceleration of vaccinations in Europe are set to result in the biggest jump in oil demand ever, a 5.2 million barrel a day rise over the next 6 months. Reuters quoted Goldman Sachs as saying in a note to clients, Goldman Sachs continues to see oil rising to $80 per barrel this summer and says that the magnitude of the coming change in the volume of demand, a change with supply, cannot match, must not be understated, as carried by FXStreet. Bottom line, our demand is going to outpace production. Biden is destroying the oil and gas industry, destroying production, the only energy that works right now. And if you think green technology is going to replace oil, go ask California, go ask Germany, go ask Texas. We don't have the tech yet. I'm going to talk more about that later. At the beginning of this month, Goldman also issued a bullish note saying that it anticipated a strong demand that would require OPEC Plus putting another 2 million barrels a day on the market in the third quarter after around 2 million barrels a day that the alliance in Saudi Arabia decided to return between May and July. In early April, the investment bank expected excess oil inventories to normalize by the fall of 2021. The excess oil inventories came from the oil supply glut due to the shale revolution, and so they're expecting those to normalize by 2021. That means supply, the demand is going to be much tighter. That means one bomb in the Middle East and oil prices are going to skyrocket just like they did back under the Obama and the Bush administration. At the end of April, Goldman Sachs continues to forecast a large demand rebound this year despite the soaring COVID cases in India, which have somewhat clouded the demand outlook. So even with all that news from COVID, I mean, a year ago today, everyone was afraid that oil demand would drop substantially and never come back. Well, here we are. Oil advanced to the highest in over a month as a combination of declining U.S. petroleum product supplies and signs of stronger demand, but stressed expectations for revival in global consumption. Futures in New York jumped 1.5% on Wednesday, posting the largest back-to-back daily gains in 2 weeks. A U.S. government report showed total petroleum stockpiles dropped last week, led by the biggest weekly decrease in distillate inventories since early March. A gauge of demand for overall petroleum products rose to the highest in more than 2 months. Meanwhile, Goldman Sachs Group Incorporated is forecasting an unprecedented jump in global oil demand as vaccination rates rise. So, look, there's confirmation coming from the mouth of many analysts, many news sources saying, look, our demand is increasing. The oil and gas supply is being reduced to ashes, and we're going to be in a situation where we're going to have very high oil prices. Oil jumps to 6-week high on stronger economic outlook. A weaker U.S. dollar today also added fuel to the oil rally. Now, what most people understand is that oil and gas is a commodity. Gold is a commodity. The reason why gold prices fluctuate is the value of U.S. currency. And so it takes dollars to trade for a barrel of oil. Inflation causes oil prices to rise because, quite simply, the lower the value of a US dollar, the more you have to trade those dollars for a barrel of oil. Some people use oil as a hedge against inflation. And so a weaker US dollar naturally causes oil prices to go up. So oil this week, which had accelerated on Wednesday when the EIA reported a small inventory build of 100,000 barrels for the week, April 23rd, and average gasoline production 9.6 million barrels a day, up from 9.4 million barrels in the previous week. So we've increased over 200,000 barrels of gasoline production from last week. So gasoline demand is rising. Middle East oil economies desperately need higher oil prices. Now, the Middle East is desperate for higher oil prices. Burhan Fitch said needs Brent at 100 to break even. Kuwait needs above 80 per barrel. Saudi Arabia, the biggest Gulf producer, needs Brent at around 70 to balance its 21 to 22 budget. The Middle East is desperate for oil and gas prices to increase. They need to balance. They've been dealing with deficits, substantial deficits. Now, less than 5 years later, Gulf economies are again in the same position. They need to reform their economies and make them less reliant, but they need oil revenues to do that. The only other option is severe austerity, which no government in the region would risk. As a result, Gulf economies are on a debt issuing spree combined with asset sales in July last year. At the height of the first wave of the pandemic, S&P Global Ratings said the Arab Gulf states were likely to amass as much as $490 billion in budget deficits by 2023. That's a massive, that's a $500 billion deficit. They don't have the economy that the American economy has. This is substantial for the Middle East. They are bleeding out. And the whole point to them allowing oil prices to the levels that they are was quite simply to take out shale. It's a waiting game. This is what I've been talking about for a long time. And what I said a year ago, it's going to reduce the Middle East to ashes. Well, they're getting there, and they're desperate, and they need to change their economy is reliant upon oil. I can't imagine them continuing to reduce oil output to increase oil prices to prop them up, quite simply to keep shale out of the game. I don't know how much longer this game can last. I don't know, and it's putting them in a desperate situation. So it's going to be interesting to see what happens here in the coming months, because if they flood the market with oil, it's going to make their situation even worse. So they're desperate for high oil prices, and desperation calls for desperate solutions. Bombs dropping is a desperate solution. So I want to talk about capital gains tax. Meanwhile, Biden is proposing a higher tax rate, long-term capital gains. Okay, 39.6% versus 20% to help fund the 1.8 trillion American Families Plan. And so there's a lot of, I talk to investors every single day. I talked to a gentleman the other day. He's looking at liquidating his Bitcoin because he doesn't want to get hit with these taxes. He doesn't want to get hit with capital gains tax. And so what does he want to do? He wants to liquefy, and now he's looking at other investment opportunities to protect himself, okay? There's a lot of people that are liquidating their real estate assets for that same reason, okay? And so bottom line, if you read the book by Robert Kiyosaki and Mr. Wheeler, Rich Dad, Poor Dad, and then they have a lot of other good books, he talks about how to reduce your taxes while investing. And so the American tax code is written in a way to channel funds to the direction they want them to go. For instance, they wanted housing more affordable. Well, the housing market, they realized that it's best to leave the housing market by the free market to allow them to build houses versus governing body to build houses, because they could do it much more efficiently, much cheaper. And so those tax incentives reduce the cost of housing. Tax incentives for oil and gas reduce the cost of energy. But they're going to take those tax benefits from real estate. They're going to take those tax benefits from oil and gas and start passing it over to green tech. Now, it made sense for oil and gas because oil and gas was proven. We knew it worked. But green technology has yet to prove itself. And if you don't believe me, read about California, read about Texas, read about Germany, read about these other countries that are trying to be reliant. I mean, without the battery technology, the bottleneck is the battery. And in order for us to have enough batteries, it's impossible. There's not enough lithium out there. The cost of lithium mining is just rising at rates to where the cost of green technology is going to be so high that you're not going to be able to afford to drive anymore. You're not going to be able to afford to heat your home anymore. You're not going to be able to afford anything anymore. Oil and gas is the cheapest energy out there. Now, Sean, they're going to come up with something amazing. Well, look, it's still in R&D stages, so they're putting our tax dollars at risk. They're gambling with our money. What I see happening is that all this money is going to be dumped in green tech and it's going to fail. And now we're going to be down the road without enough oil. Oil prices are going to skyrocket and we're going to be back to the Stone Ages importing oil from the Middle East. And they're probably going to do an oil embargo on us again like they did back in the 70s, and we're going to be waiting in line for gasoline again. Look, it doesn't look pretty for America, guys. There's never been a better time to invest in oil and gas. This might be the last year you could get a tax write-off for the oil and gas industry. And you could learn more about that by reading the books from Kiyosaki and Robert Kiyosaki and Mr. Wheeler. They talk about that, but they're going to have to change all their books after if the Biden administration does what they are, the things that I'm reading in the news, it's going to be very bad for people in real estate, people in the fossil fuel industry. I mean, fossil fuel industry has already been hit hard by COVID. I mean, first the shale wave. I mean, shale was not profitable. They thought it was. They got these big returns in the beginning, but when you're spending $20 million to go after a tight formation, because they had to have fracking technology in order to get this tight oil out of the ground in the first place. That's why the shale revolution didn't happen until 2012, because we didn't have this tech in the 80s or 90s, but we had it in 2012, which we went from 6 million a day to 13 million a day, reducing the cost of energy to the lowest it's ever been. And we were a net exporter, and we didn't have to import oil anymore from the Middle East. We didn't have to deal with $150 oil anymore every time a bomb was dropped in the Middle East, every time they wanted to do an oil embargo on us. We didn't have to do that anymore. But they found out, they dumped billions and billions of dollars into shale, but they found out that they're losing money. They're losing money. But the good news was it made energy cheaper. But the banks that backed these things, they lost money. So what do? They stopped funding the shale industry. Now, conventional oil still works today, but the banks aren't funding that stuff anymore. They got out. And so now, then we had the COVID situation, reducing oil demand. And now we have an administration that is coming against fossil fuels. And to reduce these subsidies for oil and gas, that's 4 major blows to the fossil fuel American oil and gas industry. They are going to destroy production. Production might even drop down to as low as 5 million barrels a day, the lowest we've seen since the 50s or 60s. I'm telling you guys, we are on the path for the highest oil prices has ever been, and we're putting money in the hands of evil dictators in the Middle East. I'm telling you, it's an exciting time to be in the oil and gas industry, but it's not good for those people that live paycheck to paycheck that can't afford energy prices, even where they're at today. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe, and we'll talk soon. Thanks.